now we are going to look at the accounting equation. Now, the accounting equation is the basis of everything that we do in this course. So if you can understand the accounting equation, you know how it works and you can apply it, then you will be absolutely fine and nothing in this course will be a problem for you. So what does the accounting equation do? It answers the question, what is the company worth for its owners? Okay. So the worth of a company is called owner's equity. Obviously, the company must be worth more for the owners than the money would be worth if you just put it in the bank. So you want a return on your investment, or else, after all, you will not start a company. Now, things the company owns are called assets, and things the company owes are called liabilities.
Liabilities, yeah.
So when we talk about owner's equity, we say that owner's equity is equal to everything the company owns minus everything the company owes. So owner's equity is therefore equal to assets minus liability. But almost all transactions that we are going to do will include a transfer of money. And
Yes.
money is an asset. And so, therefore, rather than starting with owner's equity is equal to assets minus liability, we say let's make the assets the subject of the formula, because we know that if there is a transfer of money, it is always going to affect our asset account. And so we rewrite that accounting equation, and now it says that assets is equal to owner's equity plus liability. So basically, the only thing that we've done is we have moved the liability to the other side of the equation, and therefore the minus became a plus.
Yes.
Now, the owner's equity will increase when the owners put money into the company, that is capital, or when the company makes a profit. Then the owner's equity increases. But the owner's equity will decrease when the owners take money out of the company, that's making a drawing, or
Yes.
make a loss.
Yes.
And profit is made when income is more than expenses, while a
Yes.
loss is made when the incomes are more,
Income.
or the income is less than the expenses, then there's a loss. And that's not the situation that we'll. So now we take this accounting equation that said asset equals owner's equity plus liability, and we now bring in these concepts. We say that if we actually look at owner's equity, it is the same as saying capital, things that we put in, minus drawing, things that the owners take out, plus income minus expenses, because that income minus expenses is just profit. And now we are sitting with something that we call the expanded accounting equation. And we are now saying that assets is equal to capital minus drawing plus income minus expenses plus liability. And every account that we are going to use in bookkeeping will either be an asset account, a capital account, a drawing account, an income account, an expense account, or a liability account. And we're going to see that on the next slide. Okay, so here is our account classification. Now, please, you will know, working in a company, that there are more accounts than these, but these are the ones that are used by the ICB in textbooks, in tests, in exams, and so that is why these are the ones that I am focusing on. So if we start by looking at our asset accounts, what we
Yes.
must do is we must distinguish between current asset accounts and non-current asset accounts. And the idea with current asset accounts is it is either money or it can be changed into money very quickly. While with non-current assets, it can be changed into money, but it's going to take a long time. And
Yes.
normally, because we now have to give a cutoff point, we say that if the asset can be turned into money within the year, we're going to call it a current asset. And if it takes longer than a year to turn it into money, then we are going to call it a non-current asset. Okay. But we just assume from the beginning that things like land, building, machinery, equipment, furniture, and vehicles, that's non-current, because there's a process that you have to go through before you can turn that into money. And then your long-term investment will be anything more than a year. That is where the year concept comes in. So our current assets will be bank, petty cash, cash float, trading inventory, debtors control, and input VAT. Okay. Then we have the two proprietary accounts. And the two proprietary accounts simply means the proprietors are the owners. These are the two accounts that relates directly to what the owners do. If the owners put in money, capital, if the owners take out money, drawings. Then we have income accounts. Okay, these are the things that we do to make money. Firstly, and most important, is sales. All our sales is income. All the services that we charge for is income. All the commission that we receive as a company is income. We can also have rental income. We might settle an account with a creditor and then we get a discount, and that'll be income. If we previously had credit losses that we are now recovering, that's an income. And of course, if we earn interest, that is income. And then we have a look at expense accounts. Now, these expense accounts, for some companies, depending on how they classify it, this can be 100 different accounts. But in our case, we're looking at 17 accounts. Cost of sales. Obviously, we first have to buy the inventory before we can sell it. Rent expense, interest expense. If we grant somebody a settlement discount, salaries and wages that we have to pay, insurance that we have to pay, repairs and maintenance that we have to pay for, advertising, postage, rates and taxes, telephone, fuel, all of those things that's due on a monthly basis, packing material, stationery, office consumables, staff refreshments, traffic fines, etc. And how I selected those, if I had a look at one of the questions in the assignment and one of these accounts came up, I just added it. And I think then when I got to 17, I realized that I've run out of space, and that's where I stopped.
Okay.
The liability accounts, once again, just like we did with the asset accounts, we have to distinguish between current liability and non-current liability. So the current liability, once again, is really stuff that is due, often within the month or within 3 months, but definitely within a year. So that is the creditors control, the people that we owe money, our short-term loans, the bank overdraft, the credit card, and the output VAT. While the non-current liability accounts are any long-term loans and the mortgage loan that we have. Okay. Now we can have a look, now that we know how the accounts work, and it's based on the expanded accounting equation. And you will notice that now with every slide, because we are using it, I'm putting that expanded accounting equation at the top, just so that I have it in mind all the time. So all accounts will appear in the general ledger. Okay. Capital accounts, drawing accounts, asset accounts, and liability accounts will appear in the balance sheet section, while all our income and expense account will appear in the income statement section of our general ledger. Okay. And it will be brought up to date at the end of each month. And this is here how the T account or the ledger account works. In the it has a T there, as you can see. Just means that it's got two sides, but it looks like a T. On the left-hand side, it is the debit side of the account, and on the right-hand side is the credit side of the account. In this case, debit simply means left and credit simply means right. Okay, so for every account, we're going to write the account name in the middle with the debit on the left and the credit on the right-hand side. And then there are 4 rules. And if you can remember the 4 rules, this means that you are never going to make a mistake in your ledger account. These are the rules. The accounting equation must always balance. It goes without saying because we have an equal sign there. Okay,
Yes.
so whatever we have on this side of the equation must be balanced out but by everything on the other side. The second rule says that for every entry into an account, there must be an entry in a contra account in another account. Okay, because if we have an asset, yes, take the simplest thing. I am buying stock or not stock. Say I am buying uh, paying salaries. Let's just I'm paying salaries. So I
Yes.
take money, the asset account, out of
Yes.
my bank account,
Yes.
and it is an expense there. I'm paying the salary to the
So,
people.
yes.
So those two amounts will obviously be the same. It's not like because I take money, I can suddenly make it more or less. Okay. This third rule says that for every debit entry, there must be a corresponding credit entry. So what that means is if this asset account that I am using is credited, then the expense account will be debited.
Yes.
Okay, so and then it's easier, I think, to start with the asset entry and remember the following rule: asset accounts increase on the debit side. So, and obviously, since we are trying to make money, we hope that we will have more assets increasing in the business than
Yes.
assets decreasing. And so it's just a logical place to start.
Yes.
So let's have a look at how this works in practice. So there, once again, I'm now going to show you how we post the accounts. So I've got my accounting equation there again on the right-hand side. And now this is what's happened. The telephone bill for April 2020 is 200. I think I must change this and make it 2000 because it's long term since I've seen a 200 Rand telephone account. So, but yeah, let's stick with it. The telephone bill for April 2020 is 200 Rand and it is paid from the bank account via EFT. So, first thing we have to do is we have to identify the asset account that is affected, and that is bank. Okay.
Yes.
And
Yes.
in this case, it is in our balance sheet section and it will
Yes.
have a number. That's what the N stands for. It's not assigned yet. So that's why I just say N. Money is leaving the asset account. So we are going to record that account on the credit side. And the way it looks, we put in the date 2020, April 30th. The detail says telephone. And
Yes.
this telephone here will be the contra account that we are going to use for the nominal section.
Yes.
Then we have a folio. The folio says, where did I get this information from? And I'm
Yes.
saying I'm getting this information from the cash book payment journal. Not that we've done that yet, we will still do it, but I'm getting this information from the cash book payment journal for this month 2. Which means that for this company, month 1 is March, their financial year end is clearly February. So March is month 1, April is month 2, and the amount as given is 200 Rand. And for now, we are ignoring that. Okay. Then we go to the contra account, was identified, it's telephone bill. So we say the name of this account is telephone. It will have a nominal number, not assigned yet, whatever we assign, and the same date, end of the month. Obviously, all of this will be end of the month stuff. Then we have the details, which is the contra account, which is bank. The folio will be the same, still use the information, and the amount is the same. So now we can see if everything, all the rules were applied. Does the accounting equation balance? Well, here we would have had minus 200, and here is an expense account and would almost be minus 200, so that is fine. It does balance. Do we have a debit for credit? Well, this is the credit side, this is the debit side. That is fine. Are the amounts the same? Yes, it is. So it seems like we have uh, satisfied all the rules, and so we know that we posted this transaction correctly in our ledger account. Now, please, um, I chose telephone bill because it is something that only happens on a monthly basis. But we are not posting every transaction into the general ledger. We are posting every transaction in the journal, and then at the end of the month, we total the journal, and then we put the amounts into the general ledger, and we bring it up to date. Okay. So in case the rules in itself does not help you and you still want to know how you can be sure that you post on the correct side, you can just write out the expanded accounting equation like that, and then say to yourself, well, I know that each one of these will have a debit and a credit side. And then I start with plus, and I simply go plus, minus, minus, plus, plus, minus, minus, plus, plus, minus, minus, plus, and then I know that I am going to be able to record the transactions correctly. At some point, it becomes second nature, but when you are starting, it's actually a good idea to go and draw this little graph here, so that when you have a transaction, you can see whether you are going to debit or credit the transaction and whether it is going to increase or decrease. That's why what the plus and the minus is for. So what this means is for an asset account, asset account always increases on the debit side and decreases on the credit side. A capital account will always increase on the credit side and decrease on the debit side. If you look at an expense account, it will always increase on the debit side and decrease on the credit side.